Welcome everybody for joining us on the GCX webinar. We're discussing the task force on climate-related financial disclosures and its impact specifically on the C-suite. For housekeeping, we've got a couple of things to note. Firstly, we are taking questions. Please feel free to send them into the question and answer session that should be at the bottom of your screen. We also have a chat room open for those of you that want to talk to each other or talk directly to the panelists, but ideally, if you could send them through to the open questions, that would be great. We're really fortunate to have a set of panelists or a group of people to have this conversation with us that are hugely experienced, firstly, but secondly, bring distinct perspectives to the table. We're really lucky to have Ohad Shachar, we call him Shachi, but Ohad's joining us from GCX. He's the Sustainability Director at GCX. He's got 15 years of sustainability consulting experience, working with companies across the JSE in all property, insurance, finance, mining, as well as fishery sectors. His speciality is the development and delivery of climate change response programs. So for those of you that aren't clued up in this sort of stuff, a little bit like me, it really deals with things like carbon footprint assessments, life cycle assessments, CDP, or carbon disclosure project submissions, and so on. We then have Engelbert. Engelbert's bringing the corporate C-suite perspective, and he's the COO of Growthpoint Management Services, 24 years of experience in real estate spanning both property management, fund and asset management functions. I'll let Engelbert talk about Growthpoint's agenda and their 2020-21 strategy, but I thought it would be pertinent to let you know that Engelbert has a unique background, combining the humanities, psychology and teaching, and leadership with risk, where he was actively involved in Investec property and Investec risk management before moving across to Growthpoint and Medboard. And then finally, but definitely not least, we have the investor perspective, and I do think this is the one that carries the most weight. Not that the rest of us aren't important, but this is the one that seems to be driving all the pressure down onto the boards and onto the C-suite. We have David Couldridge. David is head of engagement at 91. He actively works with the investment teams to develop and integrate the responsible investment practices. He spent 6 years on the Corporate Governance Network Board of SA. He sits on the CRISA Committee, a CISA Responsible Investment Committee, and David is a UCT graduate, an accountant, and I think a tax specialist looking at his CV, but I'll let the guys explain in particular where they think their roles are pertinent. So this morning's conversation is going to be an open forum for the panelists. What I'd like to be able to do is run maybe 3 to 5 minutes introduction from each of them on their perspective of this TCFD thing and what it means to them and how they're dealing with it. And then we'll open up to a couple of questions, both for me, directed directly at the panelists, but also between the panelists directed at each other. And I think we're all very aware that the TCFD is something that's come to the fore. Climate change is something that's always been around. It's taken a long time maybe to hit this level and I think, or this level of interest. But yeah, very interesting and very excited to have this conversation with everyone. All right, so let's kick off. Ohad, over to you. Your perspective of this thing called the Task Force on Climate-Related Financial Disclosures. What does it mean?
Thank you, Phil. Thanks for that. In terms of if they want to actually approach the disclosures. So digging into kind of the history, and it's a very short history, back in 2015, leaders of the G20 called on the Financial Stability Board, the FSB, to explain how climate change could impact on the global financial system. And so in response, the FSB set up this Task Force on Climate-Related Financial Disclosures, the TCFD. And essentially, this was just a working group tasked with creating a set of comparable and consistent disclosures that companies can use to demonstrate climate change resilience to their capital providers. And where this is very unique and unlike any other environmental reporting development like GRI and King 3 aligned integrated reports or the CDP disclosures, TCFD isn't really about your business's impact on the environment, but it rather swings it around and makes it more about the environment's impact on your business. And that's quite an important thing and quite unique. But that said, CDP has become quite aligned to TCFD after the past 3 years, the Carbon Disclosure Project. So if you are responding to CDP, you are starting to take these things into account. The disclosures themselves are targeted at mainstream investors, and they are intended to help them assess whether climate risk is appropriately priced into their valuations of companies in which they invest. Okay, and important to note that climate risks here spans across both the physical risks, so these are risks like decreased rainfall, exposure to increased temperatures, as well as the transitional risks. And these are risks associated with transitioning to a low carbon world. So these are risks such as exposure to carbon pricing regimes or increases in customer demand for low carbon goods and services, things like that. Okay, so what exactly are the recommendations? The recommendations were released in mid-2017, so it is still fairly new. And to summarize, the recommendations are asking that companies make disclosures within their mainstream annual financial reports based on 4 thematic areas. Those areas are governance, which is more around a company's management and the board's role in assessing, managing, and overseeing climate-related risks and opportunities. It's about strategy, about a company's forward-looking approach to the risks and opportunities that they identify and how they could impact the business model. It's around risk management, how risks are identified, assessed, and managed, and what exactly the risks are from a very financial aspect. That's quite important. It's quite a stress of measuring and quantifying those risks. And the same applies to the opportunities related to climate change when it comes to risk management, risk and opportunity management. And then it's about metrics and targets. And the metrics and targets are about what are used to assess the strategy and risk. What are they measuring to assess strategy and risk? So it goes a little bit beyond just run-of-the-mill basic greenhouse gas emissions data to more, it delves more into how you're measuring risk, really. So each of those 4 themes are then broken down to a little bit more detail, and there's a total of 11 recommendations in total. I won't get into the detail of each of those, but those disclosures are very voluntary and flexible. Okay, so they don't aim to put any additional burden on companies, although I'm sure most companies feeling that there is a burden. And so that's probably a very real feeling, and I'm sure some of the guys will say that. But they do aim to leverage your existing processes, without having to create that additional burden. And I'll try to explain that in terms of how you approach tackling this just now. So why does it matter? Why is this such a thing? And the reality is that for some companies, climate change generally does present a significant risk to the viability of the business. Certain companies are much more exposed than others, depending on their geographical span or operational activities. So a company that is exposed to agricultural activities is going to have much more exposure to physical risks of climate change. Okay, but again, this doesn't just involve physical risks. There are many other additional risks that you need to think about when transitioning to a lower carbon economy, and these could arise sooner than many people think. I mean, just over the weekend, we saw that there was the G7 summit where leaders committed to transition away from coal. What is that going to mean for companies? Okay, within the next 10 years. So these things are very real, and these risks really need to be taken into account. So also, consumers are seeking some consumers are seeking lower carbon products, shifting demand away from more traditional products and services, and businesses need to respond to this. And the TCFDs are looking at how you're doing that. So yeah, it is new. As I said, the recommendations only came out in 2017. But the support is growing exponentially. About this time last year, there were about 1,000 supporters registered on the TCFD website. I just checked last night. There's now over 2,000 supporters on the web, registered as TCFD supporters, and they span across 78 countries. It's very much a global thing. So what does it mean for companies? Companies who kind of never heard about the TCFDs, and they're getting all this pressure from their investors and other people who are asking them, are you responding? Because we're certainly hearing that all the time as climate change advisors. So, what I would generally say is that it's very much dependent on where your company is in terms of your current environmental reporting, and your general risk assessment procedures. So aligning with the TCFDs will most likely be a journey that you will be developing over much time. I don't think it's something that you can figure out straight away. I do recommend starting with a couple of very basic actions if you are thinking about the TCFDs. The first one would be to just encourage more discussion at the board level and get the right people and teams involved, be them internal or external or a mix of both. Do a gap assessment. That's probably the first step. Look at what you already say and consider what's missing when comparing yourself to the TCFDs, and then set out a plan to work up to a full disclosure. And depending on where you're currently positioned, this could span quite a few years. It's not going to happen within the first year of you saying and deciding that we want to align with TCFDs. And you might be able to produce a disclosure, but that will improve over time. And I'm sure many people will be able to attest to that, or some of the other participants here. So for example, I mean, if you haven't measured your carbon footprint, there's no point in delving straight into doing a detailed scenario analysis. I mean, that's something that's very complex, very complicated, whereas doing a simple carbon footprint is kind of a nice first step generally, just to understand. It is more about your impact on the environment, but it is a nice first step before, you know, the kind of more detailed and complex stuff that the TCFD is looking at. So, I mean, that's really all I have to say here, but I do say, you know, like if you know, a recommendation there is stay strategic, keep it material. And I do think that with the TCFDs, as well as the CDP reporting, which very much aligned to that, is sometimes less is more, you know, don't overcomplicate your response. Just try to deal with the specific points there and be transparent and kind of true to how risks impact on you.
Fantastic. Yeah. Thanks, Ohad. Yeah, that's great. I think that lays the foundation really well. I mean, I like the fact that you were able to bring it down to 3 themes, 11 recommendations, but also I like the less is more approach, because there are companies that we're dealing with or I've spoken to recently that are really struggling with trying to get to a full TCFD disclosure when they're really just trying to get their head around, you know, what the impact of climate is and what the opportunities of climate are for their businesses. You know, we've got a real estate expert on the panel today, and one that comes from a company that's well known for its green credentials, for its environmental credentials, and its responsible investment and the adoption of responsible investing in its investment process. I'm not blowing smoke up your I'm not blowing smoke. It's something that Growthpoint is well known for. It's been a leader in this field in the real estate sector for some time, Engelbert. So your perspective of TCFD, and I understand there's a lot more to responsible investing and potentially even impact investing in your case when you start moving into healthcare and so on, but what and renewable energy fields and all that sort of thing that Growthpoint's looking at. But what is your perspective of TCFD specifically, and what do you think the pressures have been on your C-suite?
Yeah, Paul, thank you very much for that introduction, and thanks for the compliment. I'm more than happy to take the compliment. I think the reality is we've got a team that has been dedicated in terms of our environmental policies and our strategies, and they've done some sterling work over the last couple of years. But nonetheless, I accept that compliment. I think one of the pressures, and I'm starting off on a lighter note, it's really the acronyms that have evolved in this space. Your typical C-suite guy is probably an accountant or an actuary or whatever the case may be. And this field is fraught with acronyms. And very often we just switch off because we don't understand it. We haven't made the time to understand it. And I think the industry probably has an obligation to try and dumb down some of these concepts for the C-suite. Because I understand the responsibility that goes with it, but we don't always understand it. That was on a lighter note. The reality is, as you know, a company playing the real estate arena, we understand that probably 30% of global energy consumption comes from the real estate sector. And that leaves us with a certain responsibility that we have to take on. So as much as these pressures are coming our way, we do want to be socially responsible citizens, and we have to act accordingly. I think one of the other issues that we are grappling with is that a lot of these policies have emanated from Europe. And to be honest, we're in a developed country. some of those rules, regulations, recommendations are quite difficult to manifest in the South African environment. You know, Ohad was saying, you know, we want to reduce the, you know, our dependency on coal. We just have to look at the South African environment and some of the issues that we've grappled with. We really do want to produce our own electricity, and we've just been unable to do so. TCFD is but one of the reporting standards that we have to consider. I just did a quick check, and during our last reporting period, we reported against 12 different frameworks. And that was a requirement from some of our investors and some of the lenders. And then we also participated in 10 different assessments, and they're all different. So to a very large extent, and we're hoping this is the case, that TCFD becomes the standard or the norm that we will be able to report against. And in fact, if you look at our results that will be coming out just after June, if you have a look at our integrated annual report, we will be reporting our results in terms of TCFD for the first time. The other thing that we really embarked on, it's helping us in this transition process, is that we've embarked on this net zero strategy some time ago. And in our mind, that is the path or the road to TCFD. Every company has to do a risk assessment. I think Ohad has really referred to that. We've done that risk assessment. We've checked the gap analysis. We understand where we are. We know where the opportunities are. We know where the costs are. And we know where our responsibilities. And now we've embarked on that process. The number of initiatives in the business is numerous. And I mean, I could probably keep you busy for a couple of hours in that regard. But in my mind, the reporting has become very strict. In the South African real estate environment, unfortunately, there has been some governance issues in the past that certainly hasn't helped us in any way. But I know the SA REIT Association has got 2 subcommittees now formed where we want to get some reporting standards, and we want to standardize that across the SA REIT environment. And we really want to self-regulate at the same time. So maybe that's just the context from a property owner. There's certainly a lot more meat to the bone, but maybe that's just the context now.
No, fantastic. Thanks, Engelbert. Yeah, I mean, you know, you really do capture the challenge when you first of all talk about the acronyms. I completely relate, having moved out of the real estate and capital sector into the sustainability world in the last 6 or 7 months. That's definitely been the biggest learning curve. And then we probably need to come up with an acronym to explain that there's too many acronyms. And then those 12 frameworks and 10 different assessments is eye-opener, and a real eye-opener, because Growthpoint has the ability and the capability and capacity to maybe deal with that, but there's a couple of small businesses that just do not have that opportunity or do not have the resources and the people to manage that sort of workload. And that's when we get to the likes of David. So David, thanks again for coming in to join us. And you really do sort of, for us, epitomize the pressure point, the point where asset owners or the allocators of capital have given money to the likes of a 91, and 91 then starts saying to the investee companies that they're investing in, okay, guys, we need to start considering this. And how what's your perspective on TCFD as a broader framework in which to put pressure on companies to disclose better so that you can price their risk better?
Thanks, Phil. Thank you, everybody. Much appreciated to have this opportunity. It sounds like I'm the villain, or we the villain.
Not at all. Not at all.
The critical part here is that we have to keep in mind that this is not about compliance, that this is about investment. So we have the incredible opportunity of investing client capital, but we have to invest it into an unknown future. And there's a whole lot of uncertainty around that future. So we have an obligation to absolutely do everything possible to understand both idiosyncratic risk of a particular company like Growthpoint or other companies, but also the systemic risks that are emerging. And clearly that is becoming noisier and noisier and of great concern to both investors, stakeholders, governments around the world. You saw what happened at the G7. It's likely that a number of governments are going to move and require compulsory reporting of risks on climate change and opportunities in terms of TCFD reporting. We are a global investor, and the FRC, Financial Reporting Council in the UK, has made it absolutely clear in their 2020 stewardship report that investment managers and asset owners have to address systemic risk as an investment issue. So this is about investment. This is about client money. And we have to be absolutely certain that we are taking great care in terms of our investment decisions on behalf of our clients. But let's just go back a bit. There's so much confusion. The acronyms, those 12 reporting standards that was referred to a little bit earlier. This creates confusion, and it creates uncertainty and hesitancy. What we encourage is that you get your head around these issues, the risks, the opportunities, as quickly as possible, and pick your road. If you're using TCFD reporting, a framework, the TCFD reporting framework, it is a very sound framework, and we expect it'll be the foundation for further sustainability reporting around systemic risks going forward. So it's a very sensible approach. But back to the earlier point, less is more. So that's really what I'm actually saying. It's really about strategy at the end of the day. And what is important to 91, particularly in the emerging markets, is that you do this work, that the board understands these issues, that the executive team makes a decision and then makes it clear that they're doing that, they're transparent about it, they're transparent about what they can do and what they can't do. And it's really about building trust in terms of the transition journey that they've decided upon in terms of dealing with these risks and opportunities. And remember, there are lots of opportunities here as well. And as a consequence, the investment industry is hurrying to ensure that clients have that opportunity to invest in sustainability type of funds or impact funds. And I think, Phil, I'll leave it there. I've said a lot, but hopefully, bottom line, the message that's coming through is be as transparent as possible, communicate clearly, look at all these acronyms and reporting standards, and choose the ones that are relevant to your business and your strategy. And then again, communicate until investors and other stakeholders get the message that you're doing the best you can in terms of the transition journey moving forward.
Fantastic. Thanks so much, David. I think that's really sound advice. I like the idea about selecting a framework and starting. You know, it's best to do it. Maybe that's not the case, actually, now that I think about it. My dad said to me once, if it's worth doing, it's worth doing badly at first, but at least you're doing it. Unfortunately, though, when we start talking about something like this, you know, you could have a material, or can you have a material impact on your share price if you really get it wrong? So, David, in your world, Are you seeing the asset owners and investment managers with the tools to be able to allocate capital differently? Are they starting to favor companies that are doing what you're saying, or are they still in their own investment processes? Is it still fairly mute? I mean, are we seeing capital flow shifting towards companies that are leading the space?
I think you definitely are seeing that, particularly what happened in 2019, 2020. The practices of asset managers and asset owners is mixed. Some have moved far along the journey, have put tools in place, have become very clear about what they're expecting, and try to keep that as simple as possible and as clear as possible. At 91, as I said a little bit earlier, we're looking for the transition journey. And we want it to be a just transition, because the challenge is that in the emerging markets where we have a lot of exposure, that tends to be where the highest carbon emitting companies and businesses are located. The assets are located there. Now, if asset owners put pressure on us, if our clients put pressure on us to move away from those emitting businesses, it would be a disaster in terms of the impact on certain countries, in terms of the impact on people in those countries, on jobs. So this has to be a very disciplined and responsible process. But having said that, Phil, we're running out of time. 29 years goes very, very quickly. And I remember I was with a very small investor 15 years or so back, where we helped to bring the Carbon Disclosure Project to South Africa. And at the time, what we said was, if companies participate in this process, then they will have time to put their processes in place to understand what is material and what they're going to measure in terms of the risks and opportunities. The TCFD takes it further. So you're looking at an integrated approach to climate risk and opportunities, bringing in the board, strategy, risk management, measuring, etc. So it's going to go very fast now, and there are going to be some companies left behind unless they have the right people at executive level, right people on the board, taking action to ensure that they have an appropriate, resilient strategy to move towards a low carbon economy. Because I promise you, 29 years goes very, very, very quickly. And just a light story about the back 15 years ago, when we brought the carbon disclosure, we helped bring the Carbon Disclosure Project to South Africa. I attended an annual general meeting in Sandton, and I asked the chairman a question, Mr. Chairman, when will you start participating in terms of the Carbon Disclosure Project? And he looked at me, and then he turned to, I think it was a company secretary next to him, and in a loud whisper, what is the Carbon Disclosure Project? But to be fair, the very next year, that particular company participated in the Carbon Disclosure Project and is actually very well known now in terms of what it's doing in this particular space. So back to the point earlier, start quickly. The investment industry, it's a little bit mixed, but at the end of the day, pick your road in terms of the C-suite, pick your road and communicate so that investors, asset owners, stakeholders understand what your journey is, and then build that trust as you measure and report going forward.
Yeah, David, you raised, I mean, I love that point around a just transition, but for me, it sort of links into almost that conflict between an emerging market imperative and a lot of the regulations that Engelbert mentioned and frameworks coming out of Europe that talk to a far more mature market in terms of both climate disclosures, but also in terms of understanding risk and people. I mean, what we're talking about when I hear you say, you know, people in action, that means investment. That means capital taken away from something else and put into understanding and doing this, even though, and Engelbert, you can come in here. Shachar, I haven't forgotten you. We will get to you shortly, I promise. But Engelbert, maybe you can come in here. Understanding how to allocate your time and resource. I mean, you mentioned the 12 frameworks and CDP, so you can thank David for that one of the assessments you said you probably had to go through. The time and investment in people that you need to put into this work to understand it, firstly, and then to report on it in such a way that it enhances your shareholder value and reduces your impact on the environment and the social community or social capital. How do you decide what's material and what's not material in that process? I mean, how do you do that materiality mapping exercise?
Yeah, Phil, thank you very much. I think before I answer that, I just want to apologize to David and say that he is not the villain. In fact, we love him very much. And in fact, we want more of his investment into our company. And not just because it's a great company to back us, but it's also the right thing to do. To expect us to report on these matters, it's material and it's important, and there's value to us at the same time. So maybe that's just the one comment that I want to make. The second comment I want to make is we are throwing resources at it, but it also requires people with skill and knowledge. Now, I'm not sure who the participants are in this webinar, but I think it's a new study, you know, a new field of study. And I think if you are well positioned, you can add enormous value to any corporate in South Africa today. So I really want to encourage those students or young professionals to, you know, to go for it. I think the world is their oyster and there's some real opportunities for them going forward. So in order for us to decide which journey or path to take on, we obviously did an environmental risk assessment probably a year ago, based on a number of assessments that we've done in the past. I can't go into details, quite complex, I don't quite understand it myself. But in terms of that, we've identified a huge list of risks, you know, some that we can manage quite quickly, some of which we need to do some long-term planning around. And based on that, we've got a to-do list effectively in our business. And there's a number of, you know, employees in the business, a number of divisions in the business that have to buy into this journey that we've undertaken. And that's just the process that we're going on.
Okay. So we get to this, some of the specific recommendations of TCFD. There's a bunch of questions coming in, so I'm trying to read those at the same time. Shachar, the thing that I found people have really struggled with, I think the 3 themes and the 11 recommendations from TCFD are fairly understandable. You know, once we take out the acronyms or explain the basic ideas, we understand the materiality. But the one that seems to be causing the most concern is the scenario analysis requirement or recommendation. And I understand, David, perhaps you can just nod your head on this one. I understand that in terms of TCFD, we're actually talking about those recommendations becoming compulsory for a number of the TCFD recommendations. You know, particularly in sort of Australia and New Zealand, but also in the UK, where we've got companies that are invested there. Some of the TCFD requirements are now no longer recommendations, but actually requirements in terms of the reporting. So Shachar, the one that seems to cause the most consternation is scenario analysis. Are we talking specifically when it comes to TCFD about climate scenario analysis, or is this a scenario analysis that extends beyond pure climate risk and opportunity?
Yeah, thanks, Phil. I think it's an interesting one, and it is one that causes a lot of concern for the people that we deal with, and I think most respondents to TCFDs. But yeah, the way scenario analysis, well, firstly, I guess we've got to understand that climate change is uncertain, right? There's no guarantee as to what the impacts are going to be, from both climate change or any environmental impacts going on into the future. And the nature of TCFD to understand risks or opportunities from this uncertain future state is really where the scenario analysis question comes out of or stems out of. So it's asking us to say, okay, well, from a range of potential future states, we might sit somewhere in the middle there, and how are each of those different states going to impact on us? And to answer your question, look, it's not only about climate change impacts. It certainly goes beyond that. But again, I think this is where we've also got to distinguish between the physical impacts on our own assets and kind of the real physical things that are going to happen with the various projected states that could happen in the future, versus the transitional impacts. And those transitional impacts are also unknown. We're talking about South Africa. South Africa's the government's submitted new NDCs in terms of how the emissions trajectory is going to pan out for them, in terms of how the South African government is going to meet its Paris obligations. And we don't know how that's going to be achieved. We've spoken about reduction in coal. Is that a possible scenario? How would that happen? Is it about transitioning, expanding the carbon tax regime into a much bigger net? Because currently it's just looking at a very heavy emitter or very high threshold of emissions. How's that going to span over the next 10, 15, 20, 30 years in terms of carbon pricing? So look, the TCFDs are very much framed and around climate change specifically, but those climate change impacts go way beyond the physical. I think that's an important thing to look at. It's really about, I think the transitional risks are probably more real and impact a much broader span of companies than the physical risks do. I don't know if that answers the question.
That's yeah, interesting. Engelbert, one of the questions that's come through is, do we expect the TCFD to expand? Or David, maybe even you could answer this. Do we expect TCFD to expand beyond just climate? So will it start looking at things like biodiversity? And Engelbert, the reason I point that at you is that you mentioned 12 different frameworks. So there's obviously a plethora of frameworks that do consider that. I think of the the Global Reporting Initiative and so on. Have you guys got a clear path in terms of prioritizing your frameworks across the broader spectrum of risk and opportunity? Is TCFD just one of them? How are you approaching that question around the broader risks and opportunities, including biodiversity? I know in Africa, for example, human rights is a massive issue. I'm dealing with a company at the moment that has investments in agriculture in Africa. So how are you approaching prioritizing that space?
Okay, yeah, so Phil, it's actually a very interesting question. You must understand that we also operate in various jurisdictions, and where we have control of other companies, we clearly have to report on them. So an example would be clearly Growthpoint South Africa, Growthpoint Properties Australia. We have outright control. We have an investment in Global Width in Eastern Europe, and then we've got outright control of a company in the UK. And we also have that investment in the V&A waterfront, for example. And I think it's hit the news where, was it the mackerels or something like that swam into the harbour, and there's a sting going on. But every little subsidiary is probably affected in a different way in terms of their reporting. So it needs to be all hands on deck, depending on where you're operating from and what your company is involved in. We also have a number of unlisted funds. And as recently as 6 months ago, we had an investor that wanted to make a sizable investment into one of our funds, and they came up with a unique set of requirements, not just TCFD, but big focus on the social impact of their investment and to what extent this unlisted fund would have an impact on the social environment. So depending on the investor and their particular requirements, you have to adapt, you have to analyze and see where the gaps are. This particular investment in the unlisted fund raised two issues that we hadn't considered before, and that was really around employment around this particular investment. So we need to put things in place that we could address that. So it all depends on the investor, and we try and be as transparent as possible in terms of all our reporting. It's good business practice. And the more we delve into it, we realize that if one particular investor is looking at one of our unlisted funds, the requirements aren't so unique and so, what's the word I'm looking for? It's not unreasonable. And then we've decided to roll it out to our broader business because we believe it should be best practice going forward.
Okay. I mean, it does sound to me, David, that the investor community has a role to play here. They want to be able to price risk and opportunity better, which is where we started off in the beginning of this conversation with the PRI. Engelbert's mentioned already that it's good business practice to be able to allow them to do that better. But what are the investors doing about consolidating all of these frameworks and these disclosures? I mean, we talk about IFRS and SASB. Are all of these things rolling up into an accounting standard? I mean, we think of accounting disclosures being 400 years old with all of that maturity and experience, and this being potentially 20 years old with lots more to go. But are the corporates going to be subjected to this for this plethora of frameworks and assessments, or are investors going to start driving a single approach in order to price risk? Or is there a single approach?
I think it's almost certain that the journey will continue towards getting there. At the moment, there's just too much. We talked about acronyms, talked about reporting standards. There's a GRI, Integrated Reporting Council, SASB, and various third-party service providers who report on ESG risk, whether it's MSCI, Sustainalytics, etc. And then, of course, there's the proxy voting, where you have institutional shareholder services, and there's a whole plethora out there. As an investor, what we try to do is, again, to really understand what we're investing in and choose from that research, from those reporting standards, what we believe is in the long-term best interests of our clients. But and that goes back to the point earlier about the complexity and the C-suite having to pick their road, because they're impacted by this. We as investors are impacted by these issues as well. And to some extent, we can help move the journey in the right direction. But there's some really important developments that are coming through. At last, we've got some sunshine in Cape Town, sorry. So there's some really important developments coming through. So IFRS, through their foundation, are going to be focusing on sustainability standards and hopefully bringing this all together. You saw last week, I think it was, that SASB and the International Integrated Reporting Council have completed their merger and are now focusing on value reporting, or calling their organization, and I can't remember the exact title, but it's something to do with value reporting. So the movement is in the right direction. While this is happening, it's really difficult for the C-suite. It's really difficult for companies. But at the end of the day, companies have to focus on their business model and strategy, taking into account all of this complexity, and at the same time moving towards a low carbon economy. And you just have to make those calls and do what's best in terms of long-term interests of the company. We as investors have to understand what investee companies are doing and then encourage them along that journey and help wherever we can in terms of the conversations we have with them and the engagements that we initiate and work with them.
Yeah, no, I get it. I really do understand it. I think I feel though, I mean, I'm watching the chat room here, and there seems to be a lot of sustainability specialists coming through saying the skills are out there. You know, these people do understand these risks and opportunities. Unfortunately, the companies aren't really employing them, and I can understand that. If you're a property company, do you necessarily have to have a climate specialist or a biodiversity specialist on your team? And I know it gets up the nose of a lot of the sustainability consultants that I've spoken to over the last 6 months. Shachar, coming back to you, have you seen a massive step change in interest around sustainability reporting? And more importantly, given your role at GCX and the fact that you guys have got this sort of metric-driven or data-driven approach, how can companies really sort of apply the Pareto principle, apply a set of indicators or metrics or measures that talk, 80% of them will talk to, you know, all of these, most of these assessments and frameworks that we've got. How are you seeing people approach this that aren't the likes of a Growthpoint?
Yeah, thanks, Phil. So yeah, to answer the first point in terms of what we've seen over the past couple of months in terms of sustainability reporting and the requirement for it, there's certainly been a groundswell. Just the acronym ESG, if we're going to add another one to the mix, although it's not a reporting framework, just that word ESG has come up more in the last 6 months than I've seen in the past, 15 years that I've been in this field. It's happened so much, and it's not a new term, but it's definitely got that investment driven focus. We're certainly seeing it coming from that investment lens now, rather than internally from some sustainability people or from pure play customers or clients asking for you to change your business, to understand what your business is doing in terms of sustainability and its sustainability practices. So there's definitely a groundswell. And I think that is why a lot of companies who are fairly new to this, who haven't kind of not, unlike Growthpoint, who's been doing this for quite a while and are still kind of grappling with all these different acronyms and frameworks and reporting frameworks. By the way, there was a question earlier around merging of biodiversity. WWF came up with the task force of nature-related financial disclosures a couple of months ago. So there's another one just to add to the list, and that might well merge with the TCFDs. But the point is that there is a lot to understand. There's a lot of things you need to know. Kind of when it comes to do your own research, it's difficult. Like, where do you start? In terms of that, I think from a GCX perspective, our approach is very much a data-driven one. That's what we've been doing for the past 10, 12 years, is just help understand the business impacts on environment, and vice versa. Now we're trying to also look at how we can now start measuring the impacts of the environment on business. But the data-driven thing it's important, because if you don't have the right data, it's very difficult to make those strategic decisions. So going back to, it's very hard to understand what is material, what isn't material. So getting a handle on data for us is always generally something that we recommend as a first step. Start to understand, once you understand what your risks are, how do you, first start getting an understanding of what the KPIs and metrics that you need to understand, and start gathering that data and looking at that data and quantifying it right, so that you can tackle that Pareto principle, that you can start looking and saying, well, why do we need to start going after these rats and mice, which is going to be a very complex, hard task, and rather focus on one or two of our key assets, which are, so that might be one of the ways of looking at it. And you can also approach it in a sustainability framework perspective. If you're talking about 20 or different frameworks that you're looking at, like which ones are the relevant ones to our business, and how do we start aligning? And there is quite a lot of work that's been done in terms of trying to align all of these frameworks out there. Yes, there's a lot of acronyms, and to David's point about it's kind of moving into, into merging into one common standard. And if you read most of these standards, they're not asking for standalone reports. They're asking your mainstream financial reports to be able to meet some of the indicators that they're looking for or the recommendations that they're dealing with. So it's about kind of structuring your integrated report to be able to tick off, you know, the SASB requirements, GRI requirements, TCFD requirements. And I think that's the complexities, to have somebody who has a really good understanding of your company and of all these frameworks and kind of weave it into one, rather than have 10 disparate types of responses.
Yeah,
I'm not sure
Shachar, so on that, yeah, no, I mean, I completely agree with you, but I have to bring in the perspective of the companies, you know, that we're talking to that are on the ground, and it's you're asking them to allocate R500,000 Rand in some cases towards these things when they're just coming out of COVID, and they're trying to get their tenants to pay rent. But so I am playing the devil's advocate here, and one of the questions that's come up, Jackie, I'm not disagreeing with you. I think I completely and agree with you that I think you can alleviate some of that pressure and potentially even some of the long-term cost, both in terms of resources and in terms of money, if you build a data set that talks to it. So I'm completely on board. One of the questions we've got coming through, and you know, Marissa's going to have to cut me here, but I think an hour is probably more than we need for this conversation. We can go over a little bit over if we have more questions coming in. But in terms of the sort of journey along that maturity continuum, David, my sense, having dealt with the international investors, is that Europe and the developed markets, UK, not so much the States, but getting there, are well ahead of us in terms of they're dealing on the sustainability continuum, understanding these emerging risks and opportunities. How far do you think South Africa is behind the international markets in terms of reporting and disclosures on sustainability issues? And I think you might be muted. You've lost your. We might have unplugged.
Can you hear me now?
Yeah, we can. David Couldridge unplugged.
I needed Engelbert to move my office around. Suddenly had the sun right in my eyes. My apologies. Yeah, so we're fortunate because of being a global investor that we've been aware of what's been coming. It's a wave. It started in the Nordic countries, Europe, etc. Basically, you're not in the game if you're not considering these issues. Clearly, as an investor, I mean, you have to demonstrate that your investment strategies are integrating these material sustainability factors into your investment analysis and decision making. So for instance, if you are a value manager, you need to show that you have clearly thought about it and brought it into the intrinsic value that you have developed for a particular investee company. Or if you're a momentum investor, that you understand how it's going to, these sustainability factors are going to impact future earnings, and you're integrating it in an appropriate manner, and you're taking into account governance or leadership of an organization to demonstrate as to whether, or should I say, how confident you are in terms of those earnings adjustments that you've made and brought into account. So this is happening. We've been under pressure from our clients around the world on this, and it's come to South Africa. The wave is broken and the expectations are great. I said 29 years earlier, but if we've got any hope at all of getting to zero by 2050, we as a world, when I talk about we, have to reduce emissions by half in every decade going forward. So by 2030, we have to, the world has to reduce emissions by half. But clearly, there is an understanding that the emerging markets are in a different place. And it appears now that G7 is making it clearer that they are prepared to pay that 100 million US dollars on an annual basis to help emerging market companies to get up to speed and move along this journey of transition to a lower carbon economy. So the critical issue is understand the risks, understand the opportunities, build that into your unique strategy, get comfortable with it, make sure the board the board is comfortable with it, the C-suite executive team are comfortable with it, the organization understands what they have to do, because unfortunately the pressures are not going to get any less for any of us. There are major issues, not only climate change, but biodiversity, forest issues. We've seen what's happened in South America. And all of those, unfortunately, are creating systemic risks that are becoming clearer and clearer. We used to talk about these issues 10, 15 years ago. Now it's becoming very clear how it's impacting countries, how it's impacting individuals, and how it's impacting investment markets.
Great. Okay. So I'm quite comfortable to wrap it up here. I think that the questions we've got largely have been covered from the audience. I think we've talked about the biodiversity. We've talked about the expansion of not just TCFD, and as we see, TCFD talks specifically to climate, but we know that ESG and sustainability incorporates a lot more than just the climate impact. Maybe in closing, a quick statement from each of you, specifically talking to what you think. I mean, I know you've covered a lot of it, but maybe one or two things, Engelbert, starting with you, one or two things that you think a C-suite member or a board member that runs the social ethics and transformation or social ethics and sustainability committee on a board, what are the two or three things you think that they need to consider right now? I mean, in order to get their firstly, the TCFD aligned, but secondly, to start walking the journey a little bit quicker, given that we don't have as much time as we thought we had.
Yeah, I think our company, and I can only speak on behalf of Growthpoint, I think we understand ESG. That we're trying to get into the DNA of our business, that everybody understands what that strategy is, what it means, and what each and every employee has an obligation to do. And in all our dealings, all our investments, and our thinking around our real estate, that ESG is it's a consideration at all times. Ohad referred to it, data, very, very, very important. I think people have reported in the past, you couldn't really check the accuracy thereof, but I think best practices in the SA REIT as they're trying to put forward will certainly assist. And then thirdly, it's easy to come up with a strategy. We had strategies a couple of years ago, and we keep refining it. And when we report now at the end of June, we've come up with a revised strategy that has been brought into by both the Social Ethics and Transformation Committee, the Risk Committee, and obviously the board as a whole, as well as EXCO. So we need to understand we can put our best foot forward. We have the strategy. We're going to do our damnedest to try and achieve that. But we will have to tweak it over time. But we would need to understand what tweaks would need to happen and how we're going to go about that.
Thanks, Albert. Appreciate it. Shachi and Ohad, in terms of your perspective, two or three things you believe that the C-suite can do now in terms of relieving some of the pressure from TCFD?
Yeah, I think it's about, going back to follow the money, and really trying to understand those financial impacts, rather the financial impacts of the risks, and quantifying those, because those are going to drive decisions at the end of the day. And that for me is also it's actually one of the most challenging parts of TCFDs, to be able to quantify that. So, really try unpack each of the risks, think about them, really think through what those risks can be. And then, how will that impact you financially in all the different financial avenues of your business? Because that's going to drive the change. So don't just think about appeasing your investors and see this as a reporting burden, but try to look at this as something that is going to make a big financial have a big financial impact on your business and understand what that is.
Fantastic insight there, David. You talk specifically to that capital allocation maturity spectrum of sort of traditional versus eventually responsible investing, and then ultimately moving into impact investing. Your final words for the C-suite listening in, or the people listening in, on what they can do that can materially relieve some of the pressure they're feeling from TCFD at the moment.
Yeah. Just building on what the other said, keep it simple. Understand your risks and opportunities, and then make sure you've got a clear strategy. And as Engelbert said, you may have to change that later on, but start. Communicate, be transparent, tell stakeholders what you can't do, what you can do, and then keep communicating and help stakeholders to understand where you are in terms of your journey. And then I think it's really important. We all understand idiosyncratic risk, the risk of a particular business, company, etc. But systemic risk is an issue that I think we struggle with, and how that's going to affect investments, particular companies, countries, as we move forward. So I would just add to that is a lot of us watch Netflix now, and just go and have a look at a new edition, and it's called Breaking Boundaries, The Science of Our Planet 2021. And you'll only have to spend an hour on it, but you will understand how important climate change is, but not just climate change, how these other systems are going to impact us all going forward over the next 30 years or so. So thank you. I think, let's leave it there.
Oh, that's amazing. All right, so I'm left purely just to close it off and thank everyone for joining us today, particularly the GCX and the ladies at RDNA for putting this together. And Engelbert and David and Shachi, thank you so much for your time. It's a really interesting conversation. I think it's an important conversation to have. And I really think you've wrapped it well for us. So once again, thanks to everybody that joined us. Thank you for your questions and your participation. Some really positive commentary coming through on the chat room. And once again, thanks very much from GCX for your time and for your insights. Really appreciate it.